Hello everyone, and welcome back to Thrive Network. In today's video, we'll explore a topic that many people are thinking about and how to navigate the challenges of the Second Great Depression. I'm your host, Austin, and in this multi-part series, we'll explore practical strategies to help you weather the storm and emerge stronger on the other side. Navigating debt management and credit repair in any economic climate. Understanding the basics of debt management and credit repair is crucial for financial health. This process involves analyzing current debts, setting up a payment plan, and learning how to avoid future financial pitfalls. Effective debt management can lead to credit score improvements, providing greater financial freedom and opportunities. Identifying the causes of your debt is a critical first step in finding the right solutions. Whether it's due to unexpected expenses, lack of budgeting, or overspending, understanding these triggers helps in creating a more effective debt management plan. This insight ensures that the solutions applied are tailored to specific needs. Creating a realistic budget for debt reduction involves listing all income sources and expenses to see where cuts can be made. Allocating more funds towards debt repayment can expedite the process, while still maintaining enough for basic needs. A realistic budget is sustainable and adjusts as financial situations change. The importance of emergency funds in debt management cannot be overstated. These funds provide a financial buffer that can keep you from accruing more debt when unexpected expenses arise. Ideally, an emergency fund should cover 3 to 6 months of living expenses to ensure it's sufficient during crises. Negotiating lower interest rates with creditors can significantly reduce the total amount owed over time. By contacting creditors and demonstrating a commitment to paying down debt, many are willing to lower rates or adjust payment terms. This strategy not only eases the debt load, but also helps in rebuilding creditworthiness. Debt consolidation can be a lifeline for those juggling multiple debts. By combining various debts into a single loan with a potentially lower interest rate, individuals can simplify their payments and potentially reduce the total interest paid over time, easing the stress of managing several creditors simultaneously. Prioritizing debts is crucial for efficient repayment. Focusing on high-interest debts first, such as credit card balances, can save money on interest in the long run. Alternatively, paying off smaller debts first can provide psychological wins that motivate individuals to keep going, a strategy known as the debt snowball method. Communicating effectively with creditors and collection agencies can significantly alter the course of debt repayment. It's important to be honest about your financial situation and to negotiate possible payment plans that fit your budget. This openness can prevent accounts from escalating to collections, preserving your credit score. Balance transfers can be a strategic tool for managing credit card debt. Transferring high-interest balances to a card with a lower interest rate, especially cards offering an introductory 0% APR, can provide a window to pay down debt more quickly without accruing excessive interest, though it's crucial to be mindful of any transfer fees. The way you manage your debt has a profound impact on your credit score. Effective debt management, such as timely payments and reducing the amount owed, helps improve your credit score over time. Conversely, mismanagement can lead to a lower score, affecting future borrowing opportunities and interest rates. Understanding your credit report and score is crucial for effective credit repair. Your credit score is derived from your credit report, which includes your payment history, debt levels, and other financial behaviors. Knowing these can help you identify areas for improvement and track your progress as you work towards better credit health. Disputing errors on your credit report is a vital step in credit repair. If you spot inaccuracies, such as incorrect account details or fraudulent activities, you can formally challenge these with credit bureaus. A successful dispute can remove these errors, potentially boosting your credit score and improving your financial options. Improving your credit score legally involves adopting consistent positive financial habits. Paying bills on time, reducing debt levels, and avoiding new credit inquiries are effective strategies. Additionally, maintaining older credit accounts can benefit your score by showing a longer history of credit use and reliability. The decision to hire a credit counselor can be beneficial. These professionals offer personalized advice on debt management and credit repair, helping to negotiate with creditors and set up manageable payment plans. However, it's important to weigh the potential costs against the benefits and consider the counselor's reputation and reliability. DIY credit repair versus professional help presents a significant decision. Managing your own credit repair can be empowering and cost-effective, allowing you to learn valuable financial management skills. However, professional services can provide expert guidance and save time, especially in complex situations, though they may come with fees. Recognizing and avoiding credit repair scams is crucial. Be wary of companies that demand upfront fees or guarantee a quick fix to your credit score. Legitimate agencies will provide a detailed plan and won't make unrealistic promises. Always research and choose services with reputable histories and positive client reviews. Building good credit habits is essential for long-term financial stability. Start by making payments on time, keeping your credit utilization low, and regularly checking your credit report for inaccuracies. Diversifying your credit mix and avoiding excessive hard inquiries can also contribute to a healthier credit profile. Regular credit monitoring plays a pivotal role in managing your financial health. It allows you to track changes and spot potential inaccuracies or fraudulent activities early on. Many services offer alerts and updates that help you stay informed about your credit status, enabling proactive management. Using secured credit cards is a strategic tool for credit repair. By depositing a security amount, you receive a credit line. This is ideal for those rebuilding credit, as it minimizes risk to the lender while allowing you to demonstrate fiscal responsibility through regular, timely payments. Debt management plans, DMPs, offer significant benefits for those struggling with multiple debts. By consolidating payments into one manageable monthly sum and often reducing interest rates, DMPs simplify the repayment process. This can help prevent missed payments and reduce the overall time spent in debt. Bankruptcy can have a profound impact on your credit score, often remaining on your credit report for up to 10 years. While it can provide relief from overwhelming debt, it should be considered a last resort. Understanding the long-term effects and exploring alternatives is crucial before making this significant decision. Dealing with debt can be psychologically taxing, leading to stress and anxiety. It's important to address these feelings by seeking support, whether through counseling, support groups, or financial education. Managing the emotional aspects of debt can empower individuals to tackle their financial challenges more effectively. Setting achievable financial goals is key to maintaining motivation during debt repayment. Break large debts into smaller, manageable milestones and celebrate when each is cleared. This not only helps keep morale high, but also provides a clear path forward in what can often feel like an overwhelming process. Financial education plays a pivotal role in preventing future debt. By understanding basic financial principles, individuals can make informed decisions, avoiding the pitfalls of high-interest loans and credit offers. Regularly engaging in educational resources can fortify one's defenses against accruing unnecessary debt. Maintaining good credit once achieved is an ongoing process. Regularly monitoring your credit report, paying bills on time, and using credit responsibly are essential habits. Additionally, staying informed about changes in credit laws and practices can help you protect and improve your credit score over time. Understanding the impact of student loans on your credit is crucial, as these loans are often a graduate's first major financial obligation. Timely payments can positively affect your credit score, while delinquencies can harm it. Effective management involves setting up automatic payments and exploring repayment plans that fit your budget. Good debt, like student loans or mortgages, can enhance your financial situation by increasing your net worth or income potential over time. Bad debt, such as high-interest credit cards, typically does not increase your wealth and can hinder financial growth. Recognizing the difference helps prioritize which debts to pay off first. Using debt management apps and tools can streamline the process of tracking and repaying debts. These tools often provide visual progress bars and reminders, making it easier to stay on top of payments. Some apps even suggest the most effective repayment strategies based on your financial data and goals. Marital debt can significantly affect both partners' credit scores and financial futures. It's important to have open discussions about debt before marriage and consider signing a prenuptial agreement that outlines the handling of existing debt. Jointly managing debt responsibly can help maintain or even improve your credit ratings. Dealing with debt collectors can be stressful, but understanding your rights can make the process smoother. Always ask for verification of the debt and communicate in writing when possible. Being informed about what collectors can and cannot do helps in negotiating and resolving debts without unnecessary stress. Understanding the terms of your credit agreement is crucial for effective debt management. It's essential to know the interest rates, penalty fees, and repayment schedule. This knowledge can help you avoid costly surprises and plan your finances more effectively, ensuring that you stay on top of your payments and maintain good credit health. Increasing your income can significantly expedite your debt repayment. Consider seeking higher-paying job opportunities, taking on part-time work, or exploring freelance options. The additional funds can be directed towards paying off your debts faster, reducing the amount paid in interest over time, and relieving financial stress more quickly. The debt snowball and debt avalanche methods are strategic approaches to paying off debt. The snowball method involves paying off the smallest debts first, while the avalanche method prioritizes debts with the highest interest rates. Both strategies can help maintain motivation and systematically reduce your debt load. Being aware of your legal rights is vital when dealing with predatory lenders. Many regions have laws designed to protect borrowers from unfair lending practices. Knowing these can help you navigate and possibly challenge high interest rates or unethical terms, which can be crucial for maintaining financial stability and avoiding debilitating debt. Planning for retirement while managing debt requires a balanced approach. Prioritize contributing to retirement savings, even if it's a small amount, while steadily paying down debts. This dual strategy helps ensure long-term financial security without letting debt consume your resources or derail your future financial plans. Avoiding debt recurrence involves adopting preventative strategies that ensure financial stability. Establishing a budget, setting aside savings, and avoiding unnecessary credit are fundamental. Education on financial literacy plays a crucial role, empowering individuals to make informed decisions that steer clear of potential debt pitfalls. The role of debt in personal financial crises cannot be underestimated. It often acts as both a symptom and a catalyst of larger financial issues. By addressing debt proactively, individuals can prevent it from escalating into a full-blown crisis, maintaining control over their financial health, and avoiding the stress that comes with overwhelming debt. Economic recessions can have a profound impact on personal debt levels, making it crucial to prepare in advance. Building an emergency fund, diversifying income sources, and reducing unnecessary expenses can fortify financial defenses against the economic downturns that exacerbate debt challenges and threaten financial security. Debt management and credit repair success stories serve as powerful motivation for those struggling with their financial journeys. These stories highlight practical steps and strategies individuals have used to overcome debt, rebuild credit, and regain financial independence, providing a roadmap for others to follow. Future trends in credit and debt management are likely to be influenced by advancements in technology and changes in regulatory frameworks. Staying informed about these changes can help individuals adapt their strategies for managing debt and repairing credit, ensuring they remain effective in the evolving financial landscape. Stay tuned for my next video, where we'll dive into more practical tips for weathering the economic storm. Don't forget to subscribe to our channel and hit that notification bell so you never miss an update. Until next time, take care and stay resilient.